Hey, what's going on, guys? Welcome back. It's Travis here with JT Wealth. It's been a long time since I posted a video, but I'm back, so let's get into it. Alright, welcome back everybody. Thanks so much for checking out today's video. I do apologize for the huge delay since my last posting, but I'm happy to be back behind the camera and putting out some new content for you guys, like today's video, which is going to be focusing on two specific dividend-paying companies. Now, both of these companies are poised to grow in the next 12 months, and also they have an around 8% dividend yield. You'll see why we're talking about these two specific companies when we get there. There's a lot of stuff going on in the world right now that lends itself well to buying into companies like these. For anyone who's been watching the channel for a long period of time, you know that Julie and I both love dividend investing. We still are pushing with our M1 Finance dividend portfolio, and we continue to put $50 a week into that. I'm going to make another update video on the status of that account shortly, but if you didn't know, we are big dividend investors. But why are dividends so important? Well, check out this slide. Alright, so this graph is showing you guys the growth of $10,000 between 1960 and 2020 when invested in the S&P 500 index, for both dividends being reinvested and dividends not being reinvested. So you can tell that not reinvesting your dividends allowed growth from $10,000 up to $627,161, which isn't crazy growth. It's pretty good, but comparatively, look at that reinvested dividend number, guys. $10,000 in the same time frame grew to be over $3.8 million. Buying into dividend-paying companies is like giving yourself a pay raise or another paycheck every quarter or every month, depending on the type of stocks you're buying into. Now, the idea for these two stocks came out of a TipRanks article titled Two Big Dividend Stocks Yielding Around 8% that is being watched seriously by Raymond James analysts. Now, the market had a very impressive week last week, its best since November of 2020, and that's on the mind of these Raymond James Chief Investment Officer Larry Adam, who wrote, "While the spring season springs forth fresh blooms, warmer temperatures, and more daylight, it may also bring renewed hopes for equities. Even though the S&P 500 is at the level it was last September, there's no reason to believe that the forecast will improve not only for us, but for the equity market as well." Among the catalysts that Adam sees boosting stocks in the weeks to come, there are three he thinks stand out significantly. The first is last week's policy shift by the Federal Reserve. With the Fed having implemented the first rate hike of the year and committed to another 3 to 6 such hikes by year's end, the central bank has removed the source of uncertainty that's been weighing on investors' minds. Second, Adam sees the current low price environment as positive for share buybacks. He believes that buybacks will increase going forward, and as companies take advantage of low share prices to make larger purchases. Finally, he points out there is a possibility of negotiations bearing fruits in the Russo-Ukraine war. So while the Russians still have the advantage through force of numbers and firepower, Ukraine's strong military defense puts that country in a sound position to enter talks. Now, Adam notes that Ukraine has expressed some willingness to accept status as a neutral state in return for cessation of hostilities. All that being said and looking good for dividend-paying companies, that brings us to the first one of the list today, and that is Sunoco. Sunoco, trading on the New York Stock Exchange, has a ticker symbol SUN and is looking at about a 9.8% potential upside in the next 12 months to an average analyst price target of $45.25. And Sunoco is an easily recognizable name for anyone who drives a car. It's the largest U.S. wholesale distributor of motor fuels, with its distribution services reaching more than 10,000 locations in 33 different states. They provide retailer with both branded and unbranded fuels, and the company's scale allows it to economize on pricing. In addition to fuel distribution, Sunoco's operations include 23 company-owned and operated fuel terminals to ensure a reliable fuel supply. Now, Sunoco LP also works in the transmix niche, collecting fuels, mainly gasoline, diesel, and jet fuels that have been mixed in the transmission pipelines, and pre-processing them to reduce waste. As far as dividends go, you can see here Sunoco's dividend dates in history have been fairly consistent for the last 9 years, trading with around an 8.01% dividend yield. Justin Jenkins, who's a 5-star analyst covering Sunoco for Raymond James, highlights the key points driving the bullish thesis for the stock. Among them are strong execution, confidence in the continuation of strong profitability, and the upside potential from medium-term business optimization and mergers and acquisitions opportunities. These efforts, along with capital and cost discipline, have allowed for considerable free cash flow generation, positioning the balance sheet with solid flexibility, which will be utilized to further grow the business. And while the macro backdrop is still throwing curveballs, we see a broadly recovering volume trend through 2022, offsetting any decrement to fuel margins. And Jenkins uses these comments to back up his outperform or buy rating on Sunoco shares, while his $48 price target implies an upside of 16% for the coming year. And based on the current dividend yield and the expected price appreciation, the stock has 24% potential total return profile. So maybe by now you've figured out what kind of stocks we're talking about. If you haven't noticed, gas is incredibly expensive, and it has been for the last couple of weeks while we're dealing with the whole Russia-Ukraine issues, right? And this is not something I see going away anytime soon, barring some considerable change in the policy of the US going forward. But since we're going to pay the price at the pump, we might as well get some of that back in the dividends from the companies we're dumping our money into just to fuel our vehicles every day. Now, the second stock we're talking about today is Holly Energy Partners, and that is ticker symbol HEP on the New York Stock Exchange, trading at $16.52 today, but they have an over 15% potential upside to possibly an analyst price target of $19 in the next 12 months. Now, HEP is a limited partnership formed by the Holly Frontier parent company to spin off and provide crude oil and refined petroleum product transport, terminal, storage, and throughput services to the oil industry generally. They operate through subsidiaries and joint ventures through which it owns and manages major assets in Idaho, Kansas, Nevada, New Mexico, Oklahoma, Texas, Utah, Washington, and Wyoming, along with some smaller assets in other states. Looking at the tip rank screen again, Holly Energy Partners' dividend dates and histories over the last 2 years showcases a strong dividend yield of about $8.49% for their yield. And you can see that little drop off, but that's more based on the price of the stock and not so much the dividend itself. So last summer, HEP announced it had entered into an agreement to buy up almost all of the assets of the venerable Sinclair Oil Company. Now, the transaction was estimated at $2.6 billion and was completed on March 15th. This merged the company, now called HF Sinclair, to replace HEP's previous parent company, Holly Frontier, and is going to trade under the new ticker symbol DINO. But with the acquisition in place, HEP will continue to operate as a partnership company and trade under its own ticker. It will own and manage the expanded logistics aspects of the combined Holly Sinclair networks, like the product, pipelines, storage, and terminals. And speaking of that deal, the Raymond James Justin Jenkins came in and said, longer term, we like the added scale and diversification from the deal. Base cash flows serve as a reliable floor. And further, with free cash flow generation relatively on track, the balance sheet remains on a favorable trajectory to absorb the cash portion of the deal. He goes on to say that Holly Sinclair franchise combinations remain front and center, and we continue to appreciate the improved scale in both refining and renewable diesel at pro forma HFC, which creates better visibility at HEP. Now, these comments support his outperform buy rating from the analyst, whose $20 price target indicates a room for 21% share growth in the year ahead. So that's Raymond James's view, but the rest of the street, they took about a 2 buys to 1 sell option, giving HEP a moderate buy rating and an average $19 price target for the year ahead, showing that again, that 15% potential upside we discussed a few slides ago. All right, guys, but those are the 2 high dividend paying stocks we're talking about today, both in the energy sector, both stocks that allow you to get a little bit of your money back for filling up your vehicle through dividend payments, and hopefully you're reinvesting them so you can take advantage of that growth into the future. As always, guys, just a disclaimer, I'm not a financial planner, I'm not your stock advisor, I'm just providing this stuff for information and entertainment purposes only. So do not go out there and buy these two stocks unless you feel that they provide value, you have done your own due diligence, and it fits and matches your risk profile going forward. I'm not telling you what to buy or what to sell. All right, but thanks again for checking out today's video, guys, and until next time, bottoms up.